has the urgency changed since you and your fellow CEOs and leaders wrote that letter just a little over a week ago?
Well, there's a reason the markets are starting to react. You can see the credit default swap spreads are changing, and there's plenty of indicators out there. So it's gotten more urgent. It just so happens that we own a bunch of technology companies. We had our annual meeting this week. So all of our companies were in, all of our investors were in. And normally you talk about technology changes, valuation, operational improvements, and now we have to talk about this. We just went through a banking crisis, wondering, kind of cost of credit. We had some SVB problems and FRB. We solved those, and now we have to deal with this. Will your cost of capital be higher in 6 months, in 3 months, in a month that you didn't know about? So the planning aspect of this is wreaking havoc on people, and so the uncertainty is the thing that people don't like dealing with right now.
So that's interesting that you've been having these meetings and it keeps coming up. How are some of the leaders and the executives planning around this or through this?
Well, fortunately, we don't use a lot of leverage in our portfolio. We have some companies, but it certainly made us think differently about it. Don't count on that, just because we don't know what the cost is going to be. We may have to use more equity, but not everybody has that leeway to do that. So that means perhaps fewer deals get done or to get done at a different price. The second thing is we rely on certain state and local government budgets. So we have companies that sell into that market. With the slugs window closed, they can't fund the infrastructure spending that they normally rely on. We need those state and local governments to be spending because we have companies that rely on those contracts. So it has implications that ripples down to the state and local level as well.
That's really interesting. It's something that perhaps a lot of lawmakers in Washington may not be immediately aware of. In your current role, you're obviously around entrepreneurs all the time. You're learning about new technologies from them, in turn helping them think through strategies, recruiting, connecting with customers. What do you think Congress and the White House as well don't fully understand about how their actions reverberate in the private sector?
I think they don't understand that the U.S. brand around the world accrues to each one of our companies, that we're viewed as understanding business, very innovative, but coming from an economy that's rock solid, that is risk-free treasuries, and that we have fiscal discipline. And so we all kind of benefit from that brand. When you start to question that a bit, well, okay, you're no different from us, you get a certain patina around that, and that people believe that we know what we're doing because we're from the U.S. And so the brand aspect of that, I think people don't quite understand that it hurts all of the companies.
Charles, that reputational risk is really interesting. I'm curious with you as an investor yourself at Recognize, does that reputational risk of these kind of chaotic conversations, of the banking crisis that's gone on with some of the important funders of places like the tech sector, like SVB, does that reputational risk pose some challenges for you as you're looking for your growth investments going forward?
Sure. So we're competing with other investors around the world. And so we want to look like we have an edge. Part of it is we have an operational background. Part of it is we're from the U.S. And part of it is we have a lower cost of capital. And so any one of those things that starts to break down, you look not as strong as you would otherwise. And you don't want people asking the question in the room, what's going on over there? And so I just think the implications for the job market in general, if we can't pay our bills, Social Security, or whether it's our military or whatever, these things start to break down. It just looks like chaos to everybody. And so I think people thought that this couldn't really happen. Maybe they're playing a game of chicken, but they always work it out. But now you never know because things have gotten so partisan. It could actually happen. And so that's what's different now is people say this could be a real thing that happens.
So then do you start looking geographically to regions outside the U.S. where the companies aren't sitting in a room and having to cope with uncertainty or kind of a pause in really innovative strategies because there's too much chaos potentially looming for the economy here in the U.S.?
Well, we've always been global. So we have companies in Ukraine, out in Latin America, all over the world. And so, but relative to where we could be investing, does it make perhaps the U.S. look a little less attractive than it would otherwise? Sure, but that's like any global investor. So that's the other thing. Capital can flow anywhere these days.
You served on President Obama's Economic Recovery Board. You also served on the board of the New York Fed. So you've seen the fallout from political intransigence and also been in rooms with policymakers to discuss the economy. How do you think the 2023 debt ceiling standoff differs from what we've seen in the past? Or is this just business as usual to some extent?
This one seems more severe. It was shorter back then in 2011, but we still lost $2.4 trillion in market cap, $1.3 billion in extra interest costs. So it had implications. This could go on longer because the size of it is so much larger, and we had certain faith back then that people had to work it out. They didn't want Armageddon to happen. We're not sure of that right now, so it makes it seem worse than it is.